Right now, something unusual is happening in the silver market. Not a rumor, not a headline, a number. On the COMEX exchange, registered silver inventories are hovering around 80 million ounces. At first glance, that might sound like a large amount of metal, but the silver market is not measured only in ounces. It's measured in claims. Because every day, traders around the world buy and sell silver through futures contracts. And those contracts represent far more silver than the physical metal that actually sits inside the vaults. In many months, the total open interest in the silver futures market represents hundreds of millions of ounces, sometimes even more, which means the system works only as long as most participants do not ask for delivery. Most contracts are rolled forward. Most positions are closed. Most traders never intend to touch physical silver at all. But occasionally, the math begins to look uncomfortable. Because when registered inventories fall, while paper claims remain large, a very simple question begins to appear. Not a speculative question, a mechanical one. What happens if more traders suddenly want the metal instead of the contract? This is where the structure of the silver market becomes extremely important. Because COMEX is not simply a trading venue, it is a delivery system. A system designed to match an enormous paper market with a relatively small pool of physical silver. And right now, that balance may be tightening. Registered inventories are shrinking, global demand for physical metal is rising, premiums in certain regions are widening, and quietly, in the background, the silver delivery mechanism may be approaching a level of stress that most investors have never looked at before. This doesn't mean the system is breaking tomorrow, but it does mean one thing. The numbers are starting to tell a story. And today, we're going to examine exactly what those numbers are saying. If you've been following the silver market for a while, you already know something most investors never notice. The price is only part of the story. Behind every commodity market sits a structure, a system designed to keep trading liquid, prices stable, and delivery manageable. Most of the time, that structure works quietly in the background. Contracts get rolled forward, positions get closed, physical delivery remains a small fraction of total trading volume. And because of that, the vast majority of investors never look beyond the price chart. But here's the reality. The silver market is not just a price discovery mechanism. It's a balancing act between paper claims and physical metal. And the people who pay attention to that balance often see changes in the system long before the headlines catch up. That's exactly what this channel is about. We don't focus on hype. We don't chase daily price predictions. Instead, we look at the mechanics of the market, inventory levels, delivery pressure, global flows of physical metal. Because when those numbers start shifting, they often reveal something deeper happening underneath the surface. So if you're watching this, you're already doing something most investors never do. You're looking at the system itself. And when you start looking at the system, the silver market begins to look very different. Which brings us to the next piece of the puzzle. Because before we talk about shortages, stress, or delivery pressure, we first need to understand what the current data is actually telling us. And right now, the numbers coming out of the silver market are starting to look unusual. Because the silver market becomes much clearer when you look at the data instead of the headlines. First, the spot price. In recent weeks, silver has been trading in a highly volatile range, moving rapidly as geopolitical tensions, currency movements, and global risk sentiment shift. But price alone does not tell the full story. What matters more is the relationship between paper markets and physical metal. Now let's look at the inventory structure on COMEX. COMEX silver vaults report two main categories of metal: eligible silver and registered silver. Eligible silver is metal stored inside the vaults, but not currently available for delivery. It belongs to private owners. Registered silver, on the other hand, is the metal that is actually available to settle futures contracts. And this is where things start to get interesting. Because registered inventories have been trending downward. In several recent reports, the total registered category has been hovering around roughly 80 million ounces. Now compare that with the scale of the futures market. Open interest in COMEX silver contracts often represents hundreds of millions of ounces of silver, sometimes several times larger than the amount of metal available for delivery. In other words, the system relies on something very important. Most traders never ask for the metal. They close the contract, they roll it forward, or they settle financially. And under normal conditions, that works perfectly fine. But when inventories shrink while open interest remains elevated, analysts begin to watch something called the coverage ratio. The coverage ratio simply measures how many paper ounces exist for each ounce of registered metal. When that ratio rises, it means the paper market is becoming larger relative to the physical pool available for delivery. And historically, When that ratio climbs too high, the market begins to experience delivery stress. Now let's add another layer: physical demand. Across multiple regions, physical silver demand has been strengthening. In some Asian markets, buyers have been willing to pay noticeable premiums above Western spot prices. And when physical buyers are paying more than the quoted paper price, it raises an important question. Is the paper price truly reflecting the physical market? Or are we starting to see the early signs of a disconnect between the two systems? Because if physical demand continues rising while registered inventories remain tight, the delivery system begins to face a very specific kind of pressure. And to understand why that pressure matters, we need to look at something many investors never examine: the difference between paper silver and physical silver. To understand why the current numbers matter, we need to look at something many investors overlook: the difference between paper silver and physical silver. Because when people talk about the silver price, they are usually referring to the price discovered on futures exchanges like COMEX. But most of the silver traded on those exchanges never actually moves. It exists as contracts, financial agreements between buyers and sellers. These contracts allow traders to speculate on the price of silver without ever touching the metal itself. And because of that, the paper market can become extremely large, many times larger than the physical supply available for delivery. Under normal circumstances, that structure works. The paper market provides liquidity. It allows miners, manufacturers, and investors to hedge price risk. But problems begin to appear when the physical market starts behaving differently from the paper market. One of the clearest signals of this divergence often appears in regional premiums. For example, in certain Asian markets, including Shanghai, buyers sometimes pay noticeably higher prices for physical silver compared to Western spot prices. These premiums represent the additional cost required to actually obtain the metal: transportation costs, local demand pressures, supply availability. But when those premiums widen significantly, they can also indicate something deeper. It may suggest that physical buyers are competing for a limited pool of metal, and when physical buyers are willing to pay more than the quoted paper price, the market begins to ask an uncomfortable question. If the futures price represents the true global price of silver, why are real buyers willing to pay more? Because at the end of the day, paper contracts can be created almost instantly, but physical silver must be mined, refined, transported, and stored. It is a real asset with real supply constraints. And when physical demand starts to rise while inventories remain tight, the gap between paper pricing and physical availability can become increasingly visible. This doesn't mean the futures market stops functioning, but it does mean the system becomes more sensitive to delivery pressure. Which brings us to the next piece of the puzzle, because the silver market has a very specific mechanism designed to handle delivery. And that mechanism revolves around something called first notice day. To understand where stress can appear in the silver market, we need to look at how delivery actually works. Because futures markets are not designed for everyone to take delivery. They are designed so that most contracts never reach that stage. Every silver futures contract on COMEX represents 5,000 ounces of silver. When traders enter these contracts, they are agreeing to either buy or sell that metal at a specific price in the future. But as the contract approaches expiration, traders usually make one of two decisions. They either close the position or they roll the contract forward into a later month. This is why the majority of futures trading never results in physical delivery. The system assumes that most participants are there to manage price exposure, not to collect bars of silver. But there is one critical moment in the futures cycle called first notice day. First notice day is the point when the exchange begins identifying which contract holders may be required to take delivery. From that moment forward, anyone still holding a long contract must be financially prepared to receive the metal, and anyone holding a short position must be prepared to deliver it. Now here's where things become interesting. If a large number of traders decide to hold their contracts into the delivery period, the system suddenly needs access to enough registered silver to satisfy those obligations. Most of the time, that pressure never materializes. Contracts are rolled, positions disappear, the system resets for the next month. But if delivery demand increases while registered inventories remain tight, analysts start watching another important signal: the relationship between available registered silver and contracts still open. Because if too many contracts remain active relative to the amount of silver available for delivery, the system can begin to experience delivery stress. And when that stress appears, the futures market may respond in several ways. Traders may rush to close positions. Spreads between contract months may widen. The market may shift from contango into backwardation, where near-term silver becomes more expensive than future delivery. Backwardation is particularly important. because it can signal that the market values immediate access to metal more than future supply. And when a commodity begins rewarding immediate delivery over future delivery, it often indicates something fundamental is happening in the physical market. But to fully understand whether today's situation is unusual, we need to zoom out, because the silver market has experienced moments like this before, and history offers some very interesting comparisons. To understand why analysts pay attention to inventory levels, we need to look at what has happened before. Because the silver market has experienced moments of extreme tension in the past, and when those moments occurred, they were usually preceded by structural imbalances inside the market. One of the most famous examples happened in 1980. During that period, silver prices surged dramatically as a group of investors attempted to accumulate a massive amount of physical silver. As demand intensified, prices accelerated upward. Eventually, silver reached nearly $50 per ounce, an extraordinary level at the time. But the rally didn't last. Exchanges rapidly changed margin requirements, liquidity tightened, and the market eventually collapsed just as violently as it had risen. The key lesson from that episode wasn't just the price spike. It was the realization that market structure matters. When positioning becomes too concentrated, or when physical demand collides with the mechanics of the futures market, the system can become unstable. Another important moment came decades later. In 2011, silver once again surged toward the $50 level. This time, the rally was driven by a mix of factors: post-financial crisis monetary policy, investor demand for hard assets, and growing distrust in traditional financial systems. For a brief period, silver became one of the most volatile commodities in the world. Prices doubled in a relatively short time. But once again, the rally ended abruptly after exchanges increased margin requirements and speculative positioning began to unwind. These historical episodes show something important. The silver market does not move in a straight line. Instead, it tends to remain quiet for long periods, and then suddenly enter phases of extreme volatility. But the catalysts behind those moves are rarely simple. They usually involve a combination of financial positioning, physical supply constraints, and macroeconomic pressure. Which brings us to the present moment. Because today's silver market is operating in a world that looks very different from either 1980 or 2011. Global supply chains are under strain. Industrial demand for silver is rising due to technologies like solar energy and electronics, and geopolitical tensions are reshaping commodity flows across multiple regions. So to understand where the silver market might be heading next, we need to examine another critical layer: the global supply and demand dynamics that sit behind the futures market. To understand the full picture of the silver market today, we need to step outside the futures exchanges for a moment, because the real supply and demand for silver is shaped by global forces: mining production, industrial consumption, investment flows, and increasingly, geopolitics. Let's start with supply. One of the largest sources of newly mined silver in the world is Mexico. For years, Mexico has remained the single biggest silver-producing country globally, but mining production is not something that can increase overnight. Opening new mines takes years. Environmental approvals take time. Infrastructure must be built. And many silver deposits are actually produced as byproducts of other metals, such as copper, lead, and zinc. Which means silver supply is often dependent on the economics of entirely different mining industries. Now look at the demand side. Silver is not only a precious metal, it is also a critical industrial metal. Modern technologies rely heavily on silver because of its electrical conductivity and durability. One of the fastest growing areas of demand in recent years has been solar energy. Solar panels require silver paste in their photovoltaic cells. And as the global push toward renewable energy accelerates, the amount of silver consumed by the solar industry continues to rise. At the same time, large consumer markets such as India and China play a major role in physical silver demand. In India, silver has long been used as a store of value, particularly in rural regions where access to financial markets may be limited. During periods of currency uncertainty or inflation concerns, demand for physical silver can increase dramatically. China, on the other hand, represents a combination of both industrial demand and investment demand. The country's massive manufacturing sector consumes large volumes of silver for electronics, batteries, and emerging technologies. And when economic uncertainty increases, Chinese investors also tend to increase their allocation to precious metals. All of these forces create a complicated global demand picture. Mining supply grows slowly. Industrial consumption continues to expand. Investment demand rises and falls depending on macroeconomic conditions. And layered on top of all of this is the financial system that trades silver through futures contracts. which means the silver market is not driven by a single factor. It is shaped by the interaction between global supply chains, financial markets, and geopolitical uncertainty. And when several of those forces begin moving in the same direction, the pressure on the system can start to build. But there is another place where stress in the silver market can sometimes be detected earlier than almost anywhere else: the derivatives market. While most investors focus on price charts, professional commodity traders often watch a different set of signals that rarely appear in mainstream headlines. One of those signals is something called the silver lease rate. The lease rate represents the cost of borrowing physical silver. In simple terms, it tells us how expensive it is for market participants to obtain physical metal temporarily. When lease rates are low, it usually means physical silver is relatively easy to access. But when lease rates begin to rise, it can signal that the supply of available metal is tightening. In certain periods of stress, lease rates have historically climbed well above normal levels. And when that happens, it often reflects increasing demand for physical silver within the financial system. Another indicator traders watch is the relationship between different futures contracts. Normally, commodities trade in a structure known as contango, where contracts for future delivery are slightly more expensive than contracts for near-term delivery. This happens because storing and financing commodities over time carries a cost. But sometimes the opposite structure appears. It's called backwardation. Backwardation occurs when near-term contracts trade at higher prices than contracts for delivery further into the future. And when that happens in precious metals, it can signal that the market values immediate access to the metal more than future supply. That situation does not happen often, but when it does appear, analysts begin to pay close attention, because it may indicate stress within the delivery system. Finally, there is another indicator that reflects uncertainty in the market: volatility. When traders are unsure about supply, demand, or macroeconomic conditions, volatility tends to rise. Options markets begin pricing in larger price swings, risk premiums increase, and the market becomes more sensitive to sudden shifts in sentiment. Taken individually, none of these indicators guarantees that the system is under pressure. But when several of them begin moving at the same time, rising lease rates, tighter spreads between contracts, and increasing volatility, they can suggest something deeper: a market that is becoming increasingly fragile beneath the surface. But to maintain perspective, it's important to acknowledge something else. There are also arguments suggesting that the current situation may not be as dramatic as some observers believe. And to understand the full picture, we need to examine the bear case. At this point, it might be tempting to assume that shrinking inventories automatically mean a shortage is coming. But markets are rarely that simple. There are several arguments suggesting that the current situation may not necessarily lead to a crisis in the silver delivery system. First, not all silver stored in COMEX vaults is classified as registered. A large portion sits in the eligible category, which means it is privately owned, but still physically present in the vault system. If market conditions change, some of that metal could potentially be converted into registered inventory and made available for delivery. In other words, the pool of silver inside the vaults may be larger than the registered category alone suggests. Second, futures exchanges have tools designed to stabilize markets during periods of extreme volatility. For example, exchanges can raise margin requirements. When margins increase, speculative traders are required to post more collateral to maintain their positions. Historically, this has often reduced speculative pressure and cooled down rapidly rising markets. Another factor to consider is the role of large institutional players. Major bullion banks and market makers operate across multiple global markets. They have access to metal flows, financing channels, and arbitrage opportunities that smaller traders do not. When price differences appear between markets, these institutions often step in to move metal and balance supply and demand. Finally, investment demand for silver can be highly cyclical. During periods of economic uncertainty, investors may rush into precious metals. But when financial conditions stabilize, that demand can fade just as quickly. Exchange-traded funds, for example, can experience significant inflows during bullish periods and equally large outflows when sentiment shifts. All of these factors mean that while inventory levels may look tight today, the system still has several mechanisms designed to absorb stress, which is why experienced market observers rarely focus on a single indicator. Instead, they watch a combination of signals over time. And that brings us to the most important question investors should be asking right now. Not what the price of silver will be tomorrow, but what signals should we be watching next? At this point, the most important thing investors can do is not to jump to conclusions. Instead, it's to watch the data carefully. because markets rarely move based on a single signal. They move when multiple signals begin pointing in the same direction. So if the silver market is entering a period of structural stress, several indicators should begin revealing that pressure. The first signal to watch is registered inventory levels. If the amount of registered silver inside COMEX vaults continues to decline, the coverage ratio between paper contracts and available metal will tighten further. That doesn't automatically create a crisis, but it does increase sensitivity inside the delivery system. The second signal is physical market premiums. If buyers in regions like Asia continue paying higher prices for physical silver compared to Western futures markets, that could indicate rising competition for real metal. Expanding premiums often suggest that physical demand is becoming stronger than the price discovered in paper markets. The third indicator is term structure in the futures market. If near-term contracts begin trading above later delivery months, creating backwardation, it may signal that the market values immediate access to silver more than future supply. That situation tends to appear only when supply conditions are tightening. Fourth, investors should watch open interest. If open interest remains elevated while registered inventories remain limited, the imbalance between paper claims and deliverable metal becomes more visible. Finally, there is ETF flow. Exchange-traded funds hold significant amounts of silver. Large inflows can remove metal from the market. Large outflows can release supply back into circulation. Taken together, these indicators form a kind of early warning system for the silver market. No single number tells the full story. But when several of these signals begin moving at once, the system can shift very quickly. And that leads us to the final point. Because whether the silver delivery system is under pressure or not, one thing is becoming increasingly clear. The silver market is entering a period where structure matters more than headlines. So where does all of this leave the silver market today? The answer is actually quite simple. The system is not broken, but it may be under pressure. Registered inventories are relatively tight. Physical demand continues to evolve across different regions, and the structure of the futures market relies heavily on the assumption that most participants will never ask for delivery. Most of the time, that assumption holds. Contracts are rolled, positions are closed, and the market continues functioning exactly as designed. But history has shown that markets occasionally enter moments when that balance becomes more fragile. When paper claims grow faster than available metal. When physical demand starts competing with financial positioning. When the mechanics of the system begin attracting attention. And those moments are usually when volatility appears. Not necessarily because the system collapses, but because the system suddenly becomes visible. And right now, the silver market may be entering one of those phases again. This is not a prediction. It's simply an observation of the structure. Because in markets like this, the most important thing investors can do is remain focused on the data. Watch the inventories, watch the spreads, watch the physical premiums. The signals are usually there long before the headlines catch up. And in a market built on both paper contracts and physical metal, understanding the system may be far more important than predicting the next price move. This is not financial advice. Always verify the data. And as always, invest with logic, not emotion.